Did you know that REITs are today trading at their lowest valuations in over a decade? The last time this happened, after the great financial crisis, REITs tripled in value in the following years. 2025 could mark another turning point for REITs, but there is a catch: not all REITs will benefit. Some will continue to struggle, while others are positioned for significant upside once macroeconomic conditions improve. Today I'll break down the best REITs to buy in 2025 with the highest upside potential. These REITs are deeply discounted, but catalysts are now forming that could send them soaring. If you're a long-term oriented investor, now might be the perfect time to position yourself before the recovery. Let's dive in. Before we get into the top picks, let's quickly address why REITs are trading at historic lows. Over the past few years, REITs have gotten hammered because of three key reasons. Firstly, rising interest rates they have led to higher debt cost, more attractive yields on bonds, and as a result, lower demand for REITs. Secondly, the office property sector has greatly suffered from the growing trend of remote working, and this has hurt the market sentiment of the entire REIT sector, despite office actually only representing about 5% of them. And thirdly, there has been some short-term oversupply issues, especially in apartments, industrial, life science, and self-storage. But here's what most investors are missing. Firstly, the Fed has already started to cut interest rates, and as inflation continues to cool down, we expect further rate cuts in the second half of 2025 and in 2026. Secondly, and perhaps more importantly, new construction starts have now collapsed, and therefore we should see a significant drop-off in new supply in the second half of 2025 and again even more so in 2026, and this should lead to a nice acceleration in rent growth. And then finally, as I mentioned earlier, valuations are today at a decade low. Many REITs are now trading at 30 to 50% discount to their net asset values, and this is why smart investors like billionaire Barry Sterlich from Starwood Capital are now loading up on REITs. Let's now go over which are the best ones to buy today. First up are apartment REITs. They've been some of the worst performing REITs in recent years due to the short-term oversupply concerns. Too many new apartments have been built in high-growth cities, rent growth has slowed down or even turned negative in some markets, and investors are fearing a prolonged downturn. But here's why I'm very bullish. Firstly, new supply is drying up fast. The high construction costs and the high interest rates have put most new projects on halt. Developers are now losing money, and so they are scaling back projects, and this should lead to a significant drop-off in supply already in the near term and lead to an acceleration in rent growth. But despite that, the market has now priced these REITs as if their growth story was completely over. I think that the market is simply being excessively focused on short-term results, and yes, they are relatively poor, but it's failing to recognize that real estate should be priced based on decades of expected future cash flow. And real estate is cyclical. You have cycles of oversupply, those are commonly then followed by cycles of undersupply with faster rent growth. And I think that we are going into another cycle of undersupply now in the coming years, and you'll see a strong acceleration in rent growth. This is very clear to us from all our conversations with various REIT management teams, but also brokerage companies. Last year, we discussed with the CEO of a BSR REIT, which is one of our top holdings at High Yield Landlord, and he made that clear to us that already in the second half of this year, they expect rent growth to accelerate. By the way, if you want to read that interview, it's completely free. I've removed the paywall. I'll put a link in the description of this video if you want to learn more about this opportunity. And I think that you should, because BSR REIT is one of our top picks in this sector right now. It's a REIT that focuses on Texan apartment communities where population and job growth is way above average. We think that its markets like Dallas, Austin, Houston are going to be some of the best performing multifamily markets over the coming decade. And despite that, this REIT is today priced at a 30% discount to its net asset value, a net asset value that we think is also quite conservatively estimated. The management is very shareholder friendly. They are themselves very big shareholders. They are buying back stock aggressively. And while you wait for the upside to be unlocked in the coming years, you're earning a roughly 5% dividend yield paid on a monthly basis. What are the catalysts? As I mentioned earlier, it's simply supply dropping off, the new supply being absorbed, rent growth accelerating. If around the same time we also get further rate cuts from the Fed, that's even better. And I think that this could ultimately send the shares 30 to 50% higher. Next up, let's talk about industrial REITs. These are companies that own massive distribution centers and warehouses that are commonly used by companies like Amazon and other e-commerce companies, but also logistic providers and manufacturers and suppliers. Right now, industrial REITs have been hit by short-term supply issues, but long-term, they remain one of the best performing real estate sectors. In that sense, the situation is very similar to multifamily. It's struggling today because of oversupply. The market is excessively focused on short-term results, which are quite poor, and it's forgetting about the bigger picture. Over the long run, industrial real estate should do quite well because the demand is growing as a result of the growing trends of e-commerce and also onshoring. And especially onshoring could really take off over the coming years due to some of President Trump's new policies, especially regarding tariffs. And so we are quite bullish on the long-term prospects of industrial properties, yet they are today heavily discounted because of short-term temporary concerns over the supply. And so what's one of our top picks today for this sector? And it is Rexford Industrial Realty, ticker symbol REXR. This is a REIT that owns mostly properties in Southern California, which is one of the most supply-constrained industrial market in the entire world. It has historically enjoyed some of the best fundamentals of the entire industrial property sector. It has managed to grow its FFO per share by 14% annually, and yet it today trades at a decade-low valuation. It has very strong balance sheet, great long-term prospects in our opinion, and ultimately we think that once again, just like in the case of BSR, once the supply comes down and dries up, it gets absorbed, we'll see an acceleration in rent growth, and this will significantly improve the market sentiment of the REIT, and it could send it about 50% higher from today's valuation. Hey, before I go into the third category of REIT in which we are heavily investing at the moment, could you please do me a huge favor and click the like button, subscribe to the channel, that will help me a lot to keep on growing. Thanks so much. Now let's talk about Canadian REITs. I'm very bullish on them because the Canadian Central Bank has been a lot more aggressive at cutting interest rates than the Fed in the US, and as a result their interest rates are today already about 100 basis points lower. On top of that, they're enjoying better supply-demand situation at the moment because their supply is better controlled. It's much harder to get building permits in Canada. Most REITs own properties in higher barrier markets where land is very scarce already. It's difficult to build new properties. Yet the demand side is also stronger because Canada is enjoying some of the fastest population growth of any Western developed countries. And so you don't have as much of these oversupply concerns that you have in the US. Interest rates are lower on top of that. And yet the valuations of Canadian REITs today are heavily discounted, and in many cases even cheaper than American REITs, because over the past year we've seen American REITs already recover a little bit as the Fed cut interest rates, but for the reasons that we knew, Canadian REITs have mostly missed out on this rally and remain heavily discounted, trading at some of the lowest levels in many years. And so what's one of our top picks among Canadian REITs? And I really like Canadian NET.REIT right now, ticker symbol NET.UN. This is a net lease REIT that focuses on triple net lease properties that typically REITs in the US like Realty Income, Agri-Realty would target. The service-oriented properties like convenience stores, gas stations, car washes, grocery stores that are leased on a triple net basis, which means that typically the lease terms is very long at 10 to 15 years. They include automatic annual rent escalations of about 2% or the inflation rate, the greater of. The tenant is typically responsible for all property expenses, including even the insurance, the maintenance, the taxes, and so it's almost like owning a bond with some inflation protection, some growth with it. So it has historically been a very rewarding property sector, and net lease REITs today have quite strongly recovered already in the US. If you look at REITs like Essential Properties Realty Trust and Agri-Realty, which we have often pitched on this channel over the past year, they've performed really well and already recovered. But Canadian NET.REIT has missed out on this recovery, and as a result today it's trading at just around 8 times FFO, which compares very favorably to the valuations of its American peers, which trade at about 2 times higher levels already. Now it is true that Canadian NET.REIT is a smaller REIT, it has more leverage, and so that increases risks and warrants a lower valuation, but we think that the discount is excessive here. We would argue that this REIT would deserve to trade at a discount, but a smaller one perhaps would deserve to trade at around 12 times FFO compared to 16 to 18 times for its American peers. And if it re-rated at 12 times FFO, that would result in about 50% upside from here. While you wait, you're also earning a near 7% dividend yield, which makes it very attractive from a risk-reward perspective. So to recap, we think that apartment REITs, industrial REITs, and Canadian REITs are some of the best REITs that you could buy in 2025 because they remain heavily discounted, in our opinion, mostly because of short-term, temporary concerns that likely won't have a major impact on their long-term fundamentals, and once these fundamentals improve, we'll think that their market sentiment will also then recover, potentially leading to significant upside, and while you wait, you're earning high dividend yields. I'm personally investing in these REITs, and at High Yield Landlord we are positioning our portfolio to maximize gains in the recovery of this REIT bear market. If you want full access to our portfolio as well as real-time trade alerts, deep dive research, exclusive CEO interviews, make sure to join us for a 2-week free trial. I'll put a link to it in the description of this video. Now let me know in the comment section below what REITs you're buying for 2025. Once more, if you could please click the like button, subscribe to the channel. Thanks so much. See you at my next one. Bye bye.